On July 24th, 2026, after the closing bell in Shanghai, the biggest shutdown of retail gold trading in history took effect. 5 of China's largest banks, the world's largest bank among them, every retail account in the product, closed. The day before, gold closed at $4,047 an ounce. The day itself, it closed at $4,055, $8.39. That's the move, 0.2%. For a month, the internet had explained exactly what this day would do to gold. The day came, and gold just sat there. And nothing happened turns out to be the most interesting thing that happened in gold all year, because of why nothing happened. By the end, you'll know what China shut down, what it deliberately left open, and why this event was never capable of moving the price. Then I'll show you one publicly reported date that explains how a story this confident got built out of numbers that were already dead. Let's give the crash its due because it was real. January 28th, 2026. Gold touches $5,595 an ounce, an all-time high. By June 30th, it's down to $3,942, a drop of 29.5% in 5 months. If you bought at the top, that hurt. But here's what got left out. Across the second quarter of 2026, gold still averaged 37% above what it averaged in the same quarter of 2025. A crash from a record high, and a market up more than a third year over year. Both true? You were told one? So, June 24th. ICBC, the largest bank on the planet by assets, tells its retail customers it's ending precious metals trading linked to the Shanghai Gold Exchange. Deadline. After the clearing session on July 24th, then Postal Savings Bank of China, then Ping An, then China Guangfa, then China Construction Bank, same direction, same window. Customers got 3 choices: close, liquidate, or take delivery of the actual metal. And here's a detail almost nobody covered. It wasn't just gold. Silver went with it, and the silver deferred contracts were in the same notices, and silver had already fallen from $121 an ounce in January to $54 in July. 55%, nearly double gold's fall. Same exchange, same shutdown, same week. And if this were really a war on paper metal, silver should have been the headline. It wasn't even a footnote, so what actually got switched off? This is where almost every version of this story went sideways. The product is called AUT plus D, a deferred settlement gold contract on the Shanghai Gold Exchange. You post margin, you get exposure to the gold price, and you never touch any gold. Deferred means it doesn't expire, it rolls indefinitely as long as you keep funding it. The appeal was leverage. Post 10%, control 10 times your money. Gold rises 5%, you made 50, that's the pitch. What the pitch leaves out is that it works identically in reverse. A 10% move against you doesn't cost you 10%, it costs you the account. Leverage doesn't multiply your view. It multiplies how wrong you're allowed to be before you're gone. So that's what closed. Now the part that matters most. Physical gold, untouched. Gold accumulation plans, where you buy real metal a little at a time, untouched. Gold ETFs, untouched. The Shanghai Gold Exchange itself, still open. Institutions still trading. Futures, still trading. China shut down gold trading makes a great thumbnail. What China actually did was ban leverage in a banking app, and then there's the genuinely strange part. In the same weeks those banks closed the leverage product, they cut the cost of buying real metal to as little as 0.2%, and they lowered the risk ratings on physical savings products, which in a Chinese bank decides which customers a salesperson is allowed to offer it to. Shut one product, subsidize the other. Same institution, same month. That's not a bank taking a view on the gold price, that's a bank being told what to sell. And to understand that instruction, you have to go back 6 years to a weekend when the oil market did something nobody had modeled. Before we get there, if China didn't crash the gold price, what did? Gold pays you nothing, no dividend, no coupon, no interest. Its real competitor is a government bond that does pay you, specifically what that bond pays after inflation, the real yield. When real yields rise, holding gold costs you more because you're giving up more income to own it. That's the whole relationship. Not complicated, just boring, which is why it doesn't trend. So, on January 28th, The day gold peaked, the 10-year real yield was 1.90%. By shutdown day, it was 2.43, 57 basis points. Over the same stretch, the dollar strengthened, and the 30-year Treasury went from 4.85 to 5.27. Every single one of those pushes gold down. Together, they explain most of a 29% drawdown, and not one of them has anything to do with Beijing. And I want to be straight with you because this cuts against me too. Those same headwinds could have hidden a bullish push from the shutdown. You can't cleanly separate them. Anyone who says they can is selling you something. April 2020. Bank of China is selling a product called Crude Oil Treasure. It tracks the price of oil. The minimum is small enough for ordinary savers. People told oil is cheap and can only go up. About 60,000 of them buy it. Then, on April 20th, the May contract for American crude does something that had never happened. It goes negative. Traders are paying people to take oil off their hands because the storage tanks are full. And 60,000 Chinese savers discover that the arithmetic doesn't stop at zero. They didn't just lose what they put in, they ended up owing the bank. Total damage, about 7 billion yuan, roughly $1 billion. 4.2 billion of customer money gone, and 5.8 billion still owed on top. Bank of China eventually absorbed the negative price losses and refunded 20% of deposits. In December 2020, the regulator fined the bank 50.5 million yuan. 50 million yuan for $1 billion hole. Honestly, that's not a punishment, that's a receipt. But the rule that Weekend wrote is the one still running in 2026. Chinese regulators came out of it with a single, very durable conviction. Ordinary savers should not be able to lose more than they put in, ever. Everything that happened to gold 6 years later is that sentence being enforced. Which brings us to why July 24th couldn't move the price. July 24th was the last page of a document that had already been written. The exchange had been closed to new retail signups since late 2020. And since 2022, ICBC and several other lenders had stopped letting existing customers open fresh positions at all. You could sell, you could close, you could not start. And then the decisive one. Margin requirements on those contracts got walked up to around 120, in some cases 140% of the contract value. Sit with that number because it's the entire story. 140% margin means that to control $1 of gold exposure, you post $1.40. More money than the position is worth. That's not leverage, that's negative leverage. You'd get better economics buying the actual metal. The product still existed, but the only reason anyone wanted it had been engineered out months earlier. So by the time they locked the door, the room was already empty. July 24th didn't remove leverage from China's gold market. That had been done already, gradually over years, by people who'd learned exactly what happens when it isn't. July 24th was the paperwork. So a real crash, a real policy, a 5-year wind down, and an event that had finished before it started. Which leaves one question. How did so many confident people get this exactly backwards? Let me give you the date I promised you. On June 9th, 2026, JP Morgan published a gold target, $6,000 an ounce by the fourth quarter. On July 3rd, 2026, JP Morgan cut that target by 25%, down to 4,500. That was public. It was reported, anyone could read it. On July 18th, 2026, 15 days later, a video went out to tens of thousands of people explaining that JP Morgan had maintained its $6,000 target through the correction, that no institution had downgraded, that the smart money hadn't blinked. I'm not naming the channel because this isn't about one channel. The same claim was everywhere. It was just 15 days out of date and nobody checked. And JP Morgan wasn't the only one. Goldman Sachs had cut its own year-end target back in June, from 5,400 to 4,900. So the actual range was this: JP Morgan, 4,500, Bank of America, 4,800, Goldman, 4,900, Morgan Stanley's upside case, 5,200, every single one of them below the number being quoted to you as current. That's not a conspiracy. Honestly, it's worse than a conspiracy, as it's just nobody checking at scale because the stale number told a better story. And somebody did get hurt here. Just not the people the story was about. Not the paper traders. They got years of warnings and a deadline with a month's notice. It was the people who bought the narrative. told a 30% drawdown was a plot, that a date on the calendar would fix it, and that the right move was to hold on and add. Under one of these videos, someone wrote that they'd bought gold at $2,800, bought again at $4,900, and now sell a coin every few months to top up $1,000 a month of retirement income. That's what a confident forecast costs when it's wrong. Not the forecaster, them. So let's finish it properly. July 23rd, the day before. 4,047.18. July 24th, the deadline itself. 4,055.57. $8.39, 0.2%, and across the whole fortnight around it, gold traded inside a 4.5% band. In a year where it had already moved 29.5. Completely, boringly normal. The event left no fingerprint in the data because the event had already happened, and yet, here's what makes this confusing. The physical demand story is real. China imported 865 tons of gold in the first half of 2026. That's up 89% on the same period in 2025. June alone was about 173 tons, the most in over 2 years. And the People's Bank of China added gold for a 20th straight month in June, 14.9 tons, its biggest since 2023, taking holdings to about 2,346 tons, still under 10% of China's reserves. So, enormous real buying, and a price that didn't move. Both true, though one detail gets skipped. A new import licensing regime started June 1st, 2026, so part of that surge is banks filling quotas, not conviction. Still a big number, just not a pure signal. Now, the standard argument goes, mine supply only grows 1 to 2% a year. It can't respond, so all this demand has to push the price up. Let's test it. In the second quarter of 2026, mine production was 965 tons, up 2%. So far, so good, but total supply that quarter was flat. So about 300 tons came from somewhere that isn't a mine, and that gap answers the best question anybody asked in this whole story. Underneath one of these videos, somebody asked, if everyone is buying gold, who's selling? Nobody answered, so let's, using the World Gold Council's numbers for the second quarter of 2026. Miners sold 965 tons of brand new metal. Every ounce of it went to a buyer. Recyclers supplied 326 tons, melted jewelry, old chains, scrap. That's roughly a quarter of all the gold that came to market. And watch this. Recycling fell 13% from the previous quarter. Why? The price dropped. Fewer people took their jewelry to the shop. Supply responded to price. That's a market behaving like a market, not a cage. ETF holders were net sellers of 45 tons. Western investors quietly redeeming all quarter. And central banks? Russia and Turkey were net sellers. In the exact same quarter, the group as a whole set a record for a second quarter. Here's the line that ties it together. Supply for the quarter: 1,268.9 tons. Demand: 1,269. It clears. It always clears. Every ounce that somebody bought was sold by somebody who wanted the money more. Everyone is buying gold has never been true in any market, ever. It can't be. And to be fair to the other side, none of this proves that big paper markets never influence the gold price. That's a real debate with serious people in it. What it shows is that this event was never going to settle it. Even the analysts who do believe in suppression weren't predicting a spike on July 24th. That certainty only appeared once the story reached YouTube. So, what do you do with this? Nothing here tells you whether to own gold. That's not my call. But on July 24th, 2026, the market handed you something rare. A clean, dated, checkable record of which explanations were describing reality and which were describing an audience. So, 3 questions. They cost you 90 seconds and they work on any headline in any market. 1. Has it already happened? If the margin requirements hit 140% 2 years ago, then the shutdown isn't news. It's bookkeeping. 2. Is the number still alive? A target from June 9th was dead by July 3rd. Check the date on every forecast anyone quotes at you. 3. What would I expect to see if this were true? And do I see it? If paper claims were holding the price down, then the day those claims disappeared should look like something. It looked like $8.39. The gold price didn't tell you the market was rigged, and it didn't tell you the market was free. It told you the story had already ended and somebody was still selling tickets. If you found this useful, there's another one on the channel that pulls apart a story just like it. Same confident headline, completely different market. And if any term in here went past you, deferred settlement, real yields, producer hedging, put it in the comments and I'll explain it properly.